growth this year is likely to be more positive than it was last year. What we are seeing analysts projecting is a growth of between 5.5 to 6%, and this is because they expect the challenges that we had last year, that is the three major challenges that we had: challenge of rate cap, which cut credit growth to the private sector, the challenge of drought, which affected farming activities. And remember, agriculture accounts for nearly a third of our nominal GDP, and we also had prolonged electioneering period, which affected decision or rather delayed decision by the private sector. All these are likely to, two of these challenges, that is politics and drought, are expected to improve or to be a bit better this year than they were last year. But we remain with only one challenge of rate cap, which has been compounded by the introduction of IFRS 9, which requires now banks to start provisioning for bad loans, or if they from the first month, whenever they see a chance or a probability of a default, they are required to start provisioning for those loans straight away. What this will do is that it's likely to slow down further credit to the private sector, especially the risky borrowers. We've seen some banks have already suspended issuance of personal loans. So credit rate cap remains the biggest threat to growth this year, but we are likely to see recovery in services sector, which kind of slowed down last year, largely on the impact of political tension, or the impacts of electioneering period, and also a bit credit squeeze, which is still there, but maybe this year we expect it to kind of improve a bit. Yeah. But we saw last year also, unlike what we've seen in the past in electioneering years, tourism also showing some growth. Official data from Kenya Tourism Board, for example, showed us that there was actually a 16% growth in the number of tourists that came in last year. That is a year-on-year growth. So tourism is also a sector that we expect to continue recovery, and given that Kenya Airways is also likely to start direct flights to New York, we are likely to see growth in the number of high-end tourists into the country, and that will be a boost to the economy this year. Inflation is likely to be lower this year because it will be coming from a higher base last year. Because of the drought, inflation last year was really high, forcing the government to implement a food subsidy program to cushion consumers from high prices of food. And food makes up the largest component of our consumer price index at about 30. Is it about over a third of that is made up of food prices. So we expect the impact or the effects or the drought that we saw last year. We don't expect it to be as much, or as we don't expect a drought to be as it was last year, to be as severe as it was last year, and this will improve agricultural production, which will help inflation. But we need to watch out on inflation. The downside risk that we need to look at is the impact that the rising global fuel prices will have on it, given that we are a net importer of petroleum, especially diesel, which basically which runs our economy. So we need to watch out. It's been rising this year. For example, today we are seeing it at just close to 70 US dollars, that is for Brent. So we need to watch out, because any increment in Brent fuel, in Brent crude above 70 US dollars may have an impact or will pose a downside risk to inflation. But overall, we expect inflation to continue slowing down. December, we saw it slow down to 4.45%. We expect it to inch or edge lower than that, especially in the first half of this year, and and maybe close at around 5% for this year. So I would see inflation as a major risk this year, as it was last year. The challenge that the Treasury faces is the mounting debt repayments. We've seen for this, for the current financial year, they have budgeted up to, I think, up to nearly half. That is at about 45% of what they expect to collect in revenue. They are going to spend that on repaying the debt that we have been accumulating. The problem with the public debt is because right now the country, being a lower middle income country, cannot access long-term concessional loans that they used to access before. So the Treasury has been forced to go for short-term commercial loans, which are very expensive. I think they need to change that strategy by maybe, they have indicated that they might go back into the international market with a second Eurobond. I think they should do, and from analysts' point of view, they are of the view that they need probably to go for a longer term facility. But this again will depend on assurance that they will give to convince investors that our growth prospects are likely, or we are likely to have sustainable growth prospects over a long period of time. So they need to watch out for that. But basically, the impact of increased debt repayment or debt service obligation to growth is that we are spending a large chunk of what we collect on repaying debts rather than pumping that into other services, government services, and that means that there might be sectors that will be hard hit because of this constraint in cash that is available for them. But the Treasury has indicated that it's likely to continue cutting down on its spending, the austerity measures, though we need real austerity measures, not a situation where we are being told it's austerity. Austerity will mean you cut the total spend, but what we've seen is that the government is not actually cutting its spend. What it's doing is reallocating cash from one sector, which it deems not to be as urgent or as much impactive on growth, then shifting that cash onto another sector. So for us to maintain that debt, we need really to have real austerities, which will mean we cut our overall spending rather than reallocating to other sectors.